Alright, so we are at the start of the week on the starting line, and this is another week we want to start with the Investors Club. So we have in front of us between 1 hour and 1.5 hours to summarize what happened in last week in the financial markets and what is ahead for us in the coming week. So with another week in the books, it's time to take a look at what might roll the dice in Wall Street this coming week. We have a couple of very interesting subjects we want to discuss with you today, and first of all we are going to take a look at one of the very interesting questions we got from one of our subscribers about Tesla. And his question was, is Tesla a good stock for long-term investment? And I'm going actually to outline the differences between trading and investing, and claiming why Tesla is a very, very good stock for day traders or for short-term traders, but not for investors. Also, we are going to ask the question, who is your financial advisors? Janet Yellen, the Federal Reserve chairwoman, actually panicked the market last week when she said that stocks price is too high, is too expensive. And we are going to take a look back in the history and to see a couple of the advices that the Federal Reserve chairman gave along the history, and was it a good advice or a bad advice, and how the market and how us as traders and investors should react for that. Further, we are going to have, as usual, a technical overview on the markets, on the S&P 500, on the Nasdaq. The S&P 500 is very, very close to all-time high. Also, we are going to take a look. We are going to take a look at the Nasdaq and on the Russell 2000, the small caps, which actually after last week they are underperforming on all the other major indexes, while they actually led the charge earlier in this year. We are going to take a look at the economic scorecard, what happened in the economic scorecard last week, and what is on the deck for us this week. What should we pay attention for in this week? Also, we are going to examine the earnings season. We are still in the earnings season for the first quarter. Right now, it's much better than what we thought 3 or 4 weeks ago, and we will see what is the state of the earnings season. The Biotech, after recent declines in the Biotech, is it time to go shopping in the Biotech? We will take a look there, and we will finish with the volume. We know that the volume is one of the major indicators for any investors or trader. It's one of the pillars of the technical analysis. Why does it lead the technicians of the markets to a false analysis time after time? And what is the real significance any one of us should squeeze out of the volume as we analyze any stock market or an index or actually any chart? So a lot to do in a short time. Let's start. So, last week US stocks, and I'll just take the laser here. US stocks closed sharply higher on Friday, and as we can see, the S&P 500 actually went up more than 1.3% on Friday, as investors cheered a job report that showed economic growth, but not enough in the eyes of most to warrant central bank tightening immediately. And analysts called the April employment figures a Goldilocks report, because it was just right for gains in stocks. And if you are not familiar with the term of a Goldilocks, it's used to describe a market scenario where the data are not too strong to cause overheating, or in this case to encourage a Fed rate hike, or is not so weak as to signal a real economic slowdown. The S&P was able to gain more than 1.3% this Friday and saved actually the week that otherwise would have gone into the red. Probably best scenario in which the market was hoping for growth, but not so strong that the Fed needs to hike in June. So the economy remains on a moderate growth track. April's job report showed a creation of 223,000 jobs and an unemployment rate of 5.4%. The average hourly earning, which is another factor in this report, increased 2.2% year over year, and that is a positive outcome in an almost zero interest rate environment. It shows consumers have some real earnings growth, but not enough to change how consumers behave. I expect that continued growth in jobs and wages will contribute to increased consumer spending later in 2015. That should be a positive catalyst for stocks and for the Fed to raise short-term interest rates later this year, and we will see why from the technical point of view we think the market is heading higher. The bias is certainly to the upside for stock prices through the summer. The economy is absolutely bouncing back from what we gather. Earnings were better than anticipated. Interest rates are low, and nobody expects a rate hike right now in June, maybe in September or just in December. And there is also a chance they are going to detain it to next week, to 2016. Looking for this week, stocks could march into record territory in the week ahead, unless the economy starts to look too strong, or then again too weak. It's a very, very thin borderline between the two. So a lot of green across the board. Only the dollar, the UUP that tracks the dollar index, went down almost 0.5%, and this is good mostly for the international stocks, and the IBB, which tracks the Biotech index, and we are going to take a look in another 30 or 40 minutes from now, actually bounced up more than 2.3%, and it is the leader. It's the best sector from the start of this year, with more than 16% gain there. Very, very nice. Let's take a look on the stock picks for this week. And each week at the start on Monday, we are posting to our Facebook community. All right, so here it is. This is our Facebook page, and you can just and you can just search for Shlomo Corporate Training, and you are welcome also to join this community and to press on like. This is a growing community all the time, and we have here the weekly stock picks. And let's just take a look at what happened last week with our stock picks. So last week we gave you YY above 67.56 and URI above 100.02, and YY actually went up more than 3% this week. And I'll just put here the chart of YY, and let's see what happened last week. So this actually was our trigger, and actually it was triggered, and we see here a great bounce up. So this is a winner, more than 3% up. The other one was URI, United Rentals, over $100. Also it did went the right way, and actually bounced about 3.5%. At the end of the week, it's up 1.5%. I've already taken a partial profit, and still we can manage the other half towards this week. What we have in store for this week? So for this week, we feature TSLA, Tesla. This is the electric car manufacturer, above $239.50. It had a great rise in the price from April, and it has a lot of momentum, and it looks great to just break out above this resistance line. And the other one is SM. It comes from the energy. The whole energy space is right now very hot. We see there along the last months a lot of movement to the upside, and right now we have a great cup in the handle technical structure on the daily chart above 59.28. This is our trigger for this week. Okay, let's go to the question of the week, and we've just seen Tesla, and the question we got from one of our traders this week is Tesla a stock for the long term? Tesla is many things. It represents a push for cleaner energy. The company is a business vehicle of a visionary, but there is one thing the electric car company is not: a stock you buy and hold. The car company, a brainchild of the CEO Elon Musk, is pushing the idea of new forms of transportation and energy storage. Such storage stocks usually captivate the attention of individual investors, but infatuation can quickly cause investors to make one of the number one mistakes: confusing a trade with a long-term investment. Investors want this company to succeed, but this is not one of the concerns of a trader. So let's take a look on the chart of Tesla. I'll get back to the chart of Tesla. This is alright. So this is TSLA. Okay, let's put here TSLA. And last week, Tesla released its financial reports. Investors were pleased to see the company's quarterly revenue jumped 54% to $1.1 billion, and as we can see on the chart, the price behaved very well. And right now, at the start of this week, we are going to see the cross between the declining 200 moving average and the midterm 50 moving average, and this is another positive indicator for the future of the price. So I like it for the short term. But if there is a company, and this is a company that is designed for traders and not for long-term investors. Even though the company is boosting revenue, investors need to remember the company still loses money, and it has its entire history. All right, along the history, it just lost money. Tesla is what I call a cult stock. This is a stock that will consistently find buyers despite a major disconnect between share price and company performance. The valuation doesn't give investors protection either, and it's trading for 30 times book value, much higher than the market's 3 times value. Yes, this stock can go up, and I believe it will go up, but investors need to be ready to cut losses if it falls. Traders' rule of thumb is to sell any stock they take if it falls 10% or more from the price you paid. I think Tesla will go higher because the cult wants it to rise. And again, my trigger for this week is exactly the trigger in our stock picks above 239.50. It looks great if it can cross this resistance line. Just look what a nice bar we had on Thursday. Right now it may take a little bit of a breathe. It may want to consolidate a little bit in its price before heading upwards, but after it went down considerably from last year high around August, around $290, it just went up, and absolutely in the past 2 or 3 weeks it broke its declining downtrend, and right now this is just a turn. This is just a turnaround in the stock, a turn in the stock, and looks great to move and to push higher. Okay, who is your financial advisor? And this is a question any of us should ask himself along his life. And financial markets encountered quite a storm last week, with massive volatility in the markets that filtered its way through other asset classes. Just as this storm was brewing, Fed Chair Janet Yellen didn't do much to put investors at ease either. In a question and answer session with the International Monetary Fund Managing Director Christine Lagarde, it took place right as US equity markets were opening for trading on Wednesday. And let's put Wednesday on the chart just for us to see it. So I'll go. Okay, I'll just take a look on let's take the 30 minutes. The 15 minutes will be alright. The 50 minutes time, and I'll just go to the SPY. Okay, and I'll just get rid from all of the moving average. We don't need them on this chart. Okay, and this is Wednesday. All right, and this is the sharp decline of Wednesday. And Wednesday, the Fed chair said equity markets values at this point generally are quite high. There are potential dangers there. This is what Yellen said. As one might imagine, those comments didn't sit well, and the S&P 500 essentially opened higher, but then just went down all the day, and actually it went down as 1% from Tuesday's close. Okay, so that brings us to a very interesting question regarding who is your financial advisor and how should one pick his financial advisor. From whom are you willing to take some tips and market wisdom? Would you let anyone be your financial advisor? Would you, for example, take Janet Yellen, the Fed chairwoman, to be your investment advisor? If your answer is yes, then you might want to think about it twice. As a general rule, I can tell you, don't take your investment advice from the head of the Federal Reserve. While the Fed does like to opine on stocks from time to time, its track record to date, and we are going to see it right now on the chart, has been less than stellar. Everyone remembers Fed Chair Alan Greenspan's statement about the irrational of prices in the stock market. That was on December 1996. The one that would have kept you, should you listen to this advice, out of one of the best bull markets in recent memory, if only he knew what the market had in store for the next 3 years, when the S&P 500, and this is the S&P 500 on the blue line, actually doubled. It's doubled in its price, and the Nasdaq went bananas. All right, and you know, even looking at the peak of the the dot-com bubble and all the collapse there, all the collapse after the burst of the dot-com bubble actually drive the stock market back to around the level of the level of the market at the time of Greenspan's statement. So so it was pity to just sit on the sidelines and to let all other investors actually capitalize on this great movement, and you are not part of this celebration. Then back in 2007, all right, it was Chairman Ben Bernanke and other officials tried to repeatedly reassure investors that the subprime crisis that took place around 2007, it burst out at October 2007 actually. They wanted to reassure investors that the crisis would be contained, the subprime is going to be contained. Whether they really believed that or were just trying to hide the bitter true state of the crisis is up for debate, but what is not debatable is that subprime was in any way contained. It wasn't. But even as late as last year, and this is the next red dot on the chart, Yellen expressed worries over the biotechs and social media stocks. She called them stretched in the price. That sparked a sell-off in these sectors, but that call too has proven to be dead wrong. We all know that the biotech afterwards went on to new highs. And we are going to discuss much deeper the biotech in a couple of minutes. The fact is that nothing good comes from the Fed commentating on the markets. It only serves to scare people from making long-term investments on quality companies, as we should, especially if the market has much more legs, as I believe, in this long-term bull. If the Fed is indeed worried about stock valuation, it has its tools at its disposal to fix the problem. The point here isn't to say that Janet Yellen is incorrect in her assessment of valuation in certain areas of the market, and ultimately she very well might be proved correct. As we all know, however, the key is timing. This is the key for traders, for investors, for anything in the financial markets. The key is timing, and the timing of many Fed officials, as we can see here on the chart, has been off with the market, and for that matter, the ultimate timing of any hike in rates. Let's take a technical view on the market. So here it is, and if we hone in on the market's movement from one day to the next, and this is the SPY, the ETF that tracks the S&P 500 on the daily chart. So from one day to the next, it looks like volatility has soared, with trading screens changing color day in and day out. If we look though at a longer term, like on the weekly chart, on the longer term perspective, it's clear that nothing has changed over the last few weeks, and the market, the S&P 500, is just consolidating in its price at the history highs. The S&P 500 continued trading in what I call a consolidating triangle pattern, and we saw this pattern last week. This is something we stressed last week. This pattern is characterized by a horizontal support level, right? Horizontal resistance level here around 212.50 on the SPY. This is on one hand, All right, and this actually obstructs the index's climb higher, and on the other hand, we have the uptrend line produced from produced in mid-October of last year, passes through going through a number of this year's low points. Okay, and if we can put it even nicely here, and this is our triangle, and as you can see, it's just very choppy around here, but and the volatility is going down, but there is a lot of choppiness between this, and this triangle pattern is coming to its resolution in this week, or maybe the week after that. When the index breaks out of this pattern, there is a high chance that it will do so in the prior trend's direction. All right, this is usually how it will go. This is usually the resolution. Seeing that the prior trend was upward, all right, we can expect a breakup of the top resistance line to a new all-time high, and thereafter a significant move higher. The S&P ended less than a point off of its all-time high at 212.50 on Friday, which the market tried to break up a number of times over the last few weeks, as we can see here. Tried here, it tried also here around late December. The more times this resistance line is tested, its resilience declines. Significant support on the S&P remains intact at the first support area at 204. All right, and let's just put the line there. All right, this is our first major support, and the other support is around just below the 200 line. This is the equivalent of the 2000 number on the S&P 500 index. As we can see, this support zone comes from a couple of touches here in mid-December, and at the start of the year, around January, we had a couple of touches there. So right now, this is the most significant support, and it should hold should we face pressure in the event of a downward move on the index. Let's go to the Nasdaq, and I'll put here the index of the Nasdaq, COMP $. All right, and while the S&P 500 is just 2 points from a new closing high and less than 10 points from a new intraday high, the Nasdaq is still over 2% from its recent high. So actually the Nasdaq looks much better from a technical point of view of the S&P 500, as it doesn't have the triangle, it doesn't have the consolidation, but all we see is a very nice uptrend together with another line which is going up, which connect all the higher highs. So in contrast to the S&P 500, here we see not only higher lows as we can see in the S&P 500, but also a higher highs, which is the exact definition of a trend that is going up. Right now, last week sell-off actually pushed the Nasdaq back to the zone of the rising 50 moving average. This is a very important support, very important level indicator to pay attention to, and next week resistance right now around 5,048, and if the Nasdaq can have a follow through for Friday's rally, we can not just overcome this resistance but push higher, maybe to challenge the all new time highs that was achieved late April. Let's from there, from the Nasdaq, let's go switch to the IWM, the Russell 2000. Actually, the Russell 2000 led the charge from the start of the year, but actually it broke its uptrend in the previous 2 weeks. Or also it went below the 50 moving average, and despite of the rally we saw in the equity market on Friday, it just went back to the 50 moving average and the 20 moving average. They are right now together, but it wasn't able to push higher. It wasn't able to overcome these levels that are now should seen as resistance. So this is the major obstacle and the major challenge for the IWM as we getting into this week. And of course, right now we want it to come up very, very quickly, not just above this moving average, but also above the rising uptrend, in order to save on its vital for next week. For next weeks. But right now the Russell 2000 is in the state of guilty till prove otherwise. I want to show you a very interesting chart of the S&P 500 intraday movements. It's going back to the start of the year, and I think this is a model very important for any of us who day trade throughout the day. And I think a lot of us as day traders, our perspective towards the market is that most of the activity, most of the movement that we can do as day traders come at the first hour or maybe the first 2 hours of the day, and we are going to see something very, very surprising when we are analyzing the intraday movements of the S&P 500. So this is the intraday composite chart of the S&P 500, and the composite looks at the average intraday pattern that the index has taken over the time period shown. And we can see here the open, all right, at the start of the day, and goes along the day till the close. This is the 6.5 hours of the activity in Wall Street. The average day in 2015 thus far has been flat until the early afternoon. So we can see here a couple of movements to the downside and also a correction to the upside, but basically it didn't do much at the start of the day. All right, it's just a choppiness and a sideways movement. By the way, just take a look that a lot of times I'm looking after the first 30 or 40 minutes for a reversal in the market, and the traders that follow me in the trading room, that every Monday I'm looking for the Monday's reversal, and I'm looking for the market to reverse just after 10 o'clock Eastern time. And just look that where it comes from, where my tendency derives from. It derives from what we see in the average model of the S&P 500 intraday movement. Now, basically, just around the afternoon, just after 1:30 in the noon, this is where the market is lift off, and it's going higher to a new high of the day, just before the selling off comes somewhat into the close, maybe just a profit taking of the charge higher. So so this is why I don't only concentrate in my day trading in the first 90 minutes from the start of the day, but also I know there are lots of great movements that we can capture in the afternoon. All right, after all the traders and all the market makers are coming back from their lunchtime, basically that was the best movement and the best consistency of the movement among all the day's movement. So this is something everyone should take a look if you are a day trader. And I know that We are leading here the trading room, and Scott is doing a great job leading you every day also around this movement towards the close. Let's go on. Let's continue and take a look at what happened last week on the economic scorecard. And earnings data may be coming in better than expected lately, but in terms of economic data, weaker than expected is still the dominant trend, and as shown right now on the chart, all right, on the table, of this week's 21 economic indicators, just 6 came in stronger than expected, and they are highlighted in green. 9 were weaker than consensus forecast, they are colored in red, and 6 were either in line or had no estimates. So this is about what we had on the economic scorecard last week. Heading into this week economic calendar, this week will be a quieter one for the economic data, with only 18 reports on the calendar. It's the data that could dominate in the week ahead. April retail sales, they are going to be released in the morning of Wednesday, and here it is, all right, 8:30 Eastern time on Wednesday, and they are one of the most important figures to look around. And of course, we on Wednesday should put on our screens retail stocks like JWN, like Nike, NKE, like Bed Bath and Beyond, BBBY, and all other stocks that tend to show volatility. So they have a good average true range. The ATR is good. Most preferably over $1 on a daily basis, and they could lead the charge. I don't know if higher or lower, but absolutely we as day traders are going to find there lots of financial opportunities on Wednesday. Also, the PPI inflation is going to be released on Thursday, and we are going to see the industrial production and the Michigan sentiment, which is always a very high report for the market. It's going to come on Friday. The task right now, the task right now is on the shoulders of the economic data to prove that the first quarter weakness was transitory. I think the markets have given the economic data a free pass till now. But now the free pass ends, and it's up to the data to put up or shut up. Let's go and take a look on the earnings season. Earnings season continued in full gear last week, with nearly 1,000 more US companies reporting their first quarter 2015 numbers. So far this season, more than 2,200 companies have reported their quarterly earning numbers, and as we can see right now on the chart, only 60.3% of the companies have beaten consensus analyst earning per share estimates. Now, towards the end of April, this is the end of April, and here we can see the percent of companies beating EPS as the season has progressed on a daily basis. Towards the end of April, we actually saw the earnings coming in well ahead of expectations compared to past quarters. However, things have taken a turn lower since April 27th, where it was the peak at 66.6, and from there the companies that have reported actually collectively been beating estimates at a much lower rate, as we can see right now, which comes to 60.3% right now. And at this rate, we actually are not even ahead of the beat rates from the prior 2 earnings season, which, as we can see here on the quarterly bars, were actually better. But if we are going to minimize our look only to the bit rate of the S&P 500 companies, although earnings had been a big concern for the market, the growth has been better than expected, and a robust 67% of the S&P 500 companies that have beaten expectations. Earnings are now up 2.2% for the first quarter for the S&P 500, and this is with about 90% or so of companies reporting till now, and that compares to expectations which were much weaker, for a 3% decline for the quarter before the earnings season has even started. So we can see here a great turnover in what were the expectations, a very gloomy expectations, and what happened at the end. It's not a great earnings season, but it's a positive earnings season, and this is what we can take from this season so far. One of the most interesting space in the market is the biotech, and we can't have too much of the biotech. There are great movements. It's a sector that that climbed hundreds of percents in the last years, and you would have to be living under a rock for the last several years not to know that biotech stocks have been the market leaders during the equity market rally. Lately, however, they have been under a bit of pressure, and let's just go to the chart, the daily chart of the IBB. This is the chart, the ETF that tracks the biotech, and as we can see now, the pressure comes of what the Fed Chair Yellen said last year, that they are overvalued stocks in the biotech, and now, and although this time she didn't mention, she said they are overvalued stocks, but she didn't specifically mention the biotech she's talking about. We know that there are a couple of overvalued names in the biotech sectors. Now, the chart here shows the IBB that tracks the Nasdaq Biotech Index going back to last October, and ever since the sector rebounded from the October lows, its 50-day moving average here, this is the green line, the rising green line on my chart, has been, as we can see, here it is. It actually been the best friend of any trader. At times when the index did experience a pullback, and let's just see a couple of pullbacks. So this is a pullback, and another pullback here around February, and another nice pullback here towards the end of March, and the last pullback is right now around May. Each time we had a pullback, the 50 moving average has been there to provide support here, and maybe, just maybe, right now around here, around the first week of May. And right now it's a little bit challenging for the sector, because what we saw this time at the end of April, the biotech just slipped down. We had a sell-off, a decline of 4% 2 weeks ago, and from there the index tried to bounce back, but it didn't manage to hold much above the 50 moving average before being sent back to the lows. But right now, with last Friday's rally, it's back above the 50-day moving average. So this is a key level going forward, and as long as the index continues to struggle with its 50 days moving average, we should take a hands-off approach to the index and of course to the IBB that tracks it. But right now we saw on Friday the IBB closes above its 50 days moving average, and it hasn't yet to convincingly break above it. We need to see a follow through maybe today on Monday, and if you want to go long the sector here, you should place a tight stop in place, maybe below the low of a Friday, just below 348 level. But I think this is a great point where you can, just join the very long-term uptrend in the biotech, and we can have a chance to see the biotech back to the high of the year around 370, and who knows, maybe to take the highs and breaking to a new territory which it has never been there. All right, so this is about the biotech, very interesting chart, and we should be all aware of. I want to finish today's presentation with something that I think lots of us are wondering about. One of the indicators that each trader and each investors are looking at and are using is the volume. And volume is one of the pillars of the technical analysis as a whole. Why does it lead the technicians in the market to a false analysis time after time? What is the significance should we give the volume as we analyze any stock or index? One of the most common complaints I always hear about the market rally in recent years is that it lacks volumes. Right, the volumes are just very anemic. And let's put here the S&P 500. Just look on the volume, all right, and try to compare them to what we usually have. And the volume is anemic, not just this year, but all through previous years, all through the last years. And and the trend has remained in place this year. Now, using the S&P 500 tracking ETF, the SPY, as a proxy, volume has only been above its average, and we used the 50 days moving average. It was above its average on 38% of all trading days this year alone, and less than a quarter of trading days in the second quarter. This is just to give us an illustration of how the volumes are low right now. Just on Friday alone, we heard multiple comments downplaying the impact of the gain due to low volume. And let's just take a look on the gap up of the market, the gap and go of the S&P 500 on Friday, but there wasn't a pickup in the volume to join the great rally on Friday. For technical analysts, volume serves as a confirmation of any rally or any decline. If a rise or fall in price occurs on heavy volume, it is supposed to serve as confirmation of the move. Therefore, with such weak volumes this year, technicians would say the recent new highs in the S&P 500 is illusory and fleeting. The problem with this logic is that if volume was the yardstick to measure the legitimacy of a market's move, then this entire bull market wouldn't count. Some have actually made this argument and remained on the sidelines for the entirety of this bull market, but The fact is that the current bull market is already the fourth longest on record and will become the third longest if the S&P 500 manages to get this week back to its prior highs. So, it's just ridiculous to give the volume such an importance role when it just keep you away and leave you on the sidelines when there is the one of the biggest celebration in the stock market in the history of the markets. To really drive this point home, we ran an analysis of the performance of the S&P 500 during this whole bull market on days when volume in the SPY was above and below the 50 days moving average. And and the results are just breathtaking. On days when volume was above average, the S&P 500 has averaged a decline of 0.11%. But on days when volume was below average, the S&P 500 has risen on average of 0.19%. Rallies on below average volume may not count for the technical analysts, but they sure add up. Since the bull market began in March 2009, the S&P 500 has risen more than 207%. This is the blue line we have here on the chart. Now, let's just say that you can expect on any given day whether it's going to be a day with a volume above average or below average, and therefore someone gives you the option of choosing between the returns on days when volume was above or below average. Which would you choose? All right, so think carefully. All right, again, if you can choose on whatever days to be involved in the S&P 500 movement, whether you want to be part of the movement on days with above than average volume or below than average volume, which one you choose, which one you take. If you had only chosen to invest in the market on the more meaningful above average volume days, you would be down more than 50%, actually more than 51%. This is the green line here on the chart. All right. On the other side of the trade, taking the returns on those days when volume actually was below average would have yielded a return of over 500%, actually more than 528% from March 2009. This is the rising red chart here above the other lines. So you can give whatever meaning you want to these returns, but it's hard to imagine turning down a gain of over 500%. So we shouldn't give the importance for the volume as the technical analysis give. We need to take it other place, and actually the volume just tell us where is the point where the most buyers and sellers think this is the right place for the market. This is the correct price for the market. It's just going to the poll and to vote to your favorite party. So instead of voting for your party, you are voting for the price. So when the volume is high, it's just voting for the price. But we have to understand that the market, although most of us are traders, the market is for investors, was created for long-term investors, and 95% of all the players in the market are investors. That means usually they are just thinking to go long and to go higher and higher as the uptrend can lead them. That means actually that when we see declines, when the decline days are coming, they are actually brushing all the profits off the table, and they are just raising all the fear of the long-term investors. This is where the crowd is just looking for the exit door, and this is why we see a pickup in the volume on down days, on declines. That doesn't mean this is a turn point. That doesn't mean we should sell on these days. On the contrary, actually, when there is a sea of red on the screens, this is exactly where we should buy, should we believe in the long-term story of the market. Thank you very much, everyone, for being here with me for the last hour. As always, you can write me to Shlomo. I'll just write it down, shlomo@tradenet.com. We will be more than happy to see you in our community in Facebook. I wish every one of you a very successful week in trading and in investing, and I'll see everyone here next week at the same hour, 8 o'clock Eastern Time, just before the wheels of Wall Street are starting to roll. Thank you very much, and see you around.